Let's talk a little bit about inventory management just in time and backflush costing. All right, with inventory management in retail organizations, inventory management involves planning, coordinating, and controlling activities relating to the flow of inventory in, through, and out of the organization. When we think about cost associated with goods for sale, we're concerned with managing inventories to increase net income so that we can effectively manage costs that fall into the following 5 categories: purchasing cost, ordering cost, carrying cost, stockout costs, and quality costs. In the area of purchasing cost, here we're talking about the cost of goods acquired from suppliers. It does include freight. When we talk about ordering cost, we're talking about the cost of preparing and issuing purchase orders, receiving and inspecting items that were included in those orders, and matching the invoices received to the purchase order and delivery of the records to make the payments. With regard to carrying cost, these arise while holding inventory of goods for sale. So we need to include the opportunity cost of the investment tied up in inventory and also costs associated with storage. Stockout costs are the costs that result when a company runs out of a particular item for which there is customer demand, a stockout if you will, and the company must act quickly to meet the demand or suffer the cost of not meeting it. Quality costs are costs that result when features and characteristics of a product or service are not in conformance with customer specifications. And typically, we break out quality costs into categories including prevention, appraisal, internal failure, external and external failure. Sometimes there's a fifth one. The first step in managing goods for sale involves how much to order for a given product. And here we're concerned with the idea of EOQ, or economic order quantity. And it's a decision model that calculates the optimal quantity of inventory to order under certain set of circumstances. Okay, let's go over some of the assumptions. The assumptions include that there are only ordering and carrying costs, and that the same quantity is ordered at each reorder point. Demand, purchase order lead time, ordering cost, and carrying cost are all known with certainty. Purchasing cost per unit would be unaffected by the quantity ordered. And no stockouts occur. Well, we've got a few more too. EOQ ignores purchasing costs, stockout costs, and quality costs. All right, the formula itself says you take the square root of 2dp divided by c. That's square root. I should pronounce that correctly. I apologize, everyone. D stands for demand in units for a specified period. P is the relevant ordering cost per purchase order. And C is the relevant carrying cost per 1 unit in stock for the time period used for D. All right, the second decision in managing goods for sale is when to order a given product. The reorder point is the quantity level of inventory on hand that triggers a new purchase order. So the reorder point is equal to the number of units sold per unit of time times the purchase order lead time. When we talk about inventory management and safety stock, we need to understand that safety stock is inventory held at all times, regardless of the quantity of inventory ordered using the EOQ model. It's a buffer against unexpected increases in demand or uncertainty about lead time, and it's a buffer against the unavailability of stock from suppliers. Now, before we talked about carrying cost, stockout cost, and ordering cost, let me see if I can go back there. We would want to estimate inventory related relevant cost, and they fall into 3 categories: carrying cost, stockout cost, and ordering costs. Carrying costs represent relevant inventory carrying costs consisting of the incremental cost and the relevant opportunity cost of capital. So the whole idea here is that we are paying attention to what what incremental costs we incur as a result of holding inventory, but we also pay attention to the fact that we have money tied up in inventory, and that money could be used for other alternatives. Okay, relevant incremental costs are cost of the purchasing firm that change with the quantity of inventory held. Now, the opportunity cost concept represents the opportunity foregone, or the lost opportunity foregone, since we had money tied up in inventory and it could have been used in some other purpose. So we would need to take the required rate of return multiplied by the unit costs that vary with the number of units purchased and are incurred at the time the units are received. That's one method of measuring the relevant opportunity cost of capital as part of our carrying costs. Now, we also need to work on the cost of a prediction error, and there's 3 steps in determining the cost of a prediction error. 1, we compute the monetary outcome from the best action that could be taken, given the actual amount of the cost per purchase order. 2, we could compute the monetary outcome from the best action based on the incorrect amount, and 3 would be compare the differences. Let's talk for a moment about just-in-time purchasing. It's the idea that purchase of materials or goods are delivered just as they are needed for productions or sales purposes. It's popular because carrying costs are actually much greater than estimated, because there are warehousing, handling, I think that should say handling rather than handing, shrinkage, and investment costs that have not been correctly estimated. At least that's the traditional view. Just-in-time purchasing can reduce the cost of placing a purchase order because long-term purchase agreements define the price and the quality terms. Individual purchase orders covered by those agreements require no additional negotiation regarding price or quality. Now, sometimes what this means is we set up what's called a blanket purchase order, and then the specific purchase orders are simply ordering against the blanket. So all the terms and conditions were specified in the blanket PO. Companies that use electronic links, that's a necessary step as well as part of JIT purchasing. And then that way, if we're using electronic links, whether it's through EDI or the internet, we've greatly reduced the transaction cost of placing purchase orders. And another step involved in JIT purchasing is to use purchase order cards, usually for smaller, less critical items, smaller dollar items. Alright, so purchasing costs are relevant in JIT purchasing, so are stockout cost, and quality is always a concern. Let's talk about JIT purchasing in terms of supply chain analysis. Supply chain is the concept where we describe the flow of goods, services, and information from the beginning through the end, right? So from the initial source of materials to the delivery of the products or the services at the tail end. And supply chain involves both the internal supply chain as well as the external supply chain. Though sometimes it depends on the context of how the term supply chain is using, whether it means internal and external. Okay. Supply chain members typically will share information so that they can do a greater job of planning and coordinating activities. And supplier evaluations are critical as part of the JIT purchasing implementation. Moving to the area of inventory management and MRP, or materials requirements planning, keep in mind this is a push-through system that manufactures finished goods for inventory on the basis of demand forecasts. So there's 3 pieces of information that are used to determine the necessary output at every stage in production when we're using MRP. We base it on demand forecast of the final products. We base it on a bill of materials, which lists all the materials that must be used, what components are involved, what sub-assemblies are involved in every final product. And the quantities of the materials, the components, and product inventories are also used to determine the necessary output at each stage of production. Now, MRP takes into account the lead time to purchase materials and to manufacture components and finished products. It sets a master production schedule specifying quantities and timing of each item to be produced. The output of the department is pushed through the production line whether it is needed or not. And the push-through may result in accumulation of inventory. JIT production, or lean production, sometimes called lean manufacturing, is a demand pull system rather than a demand push. We only manufacture each component as soon as it is needed and only when it's needed by the next step in the production line. So downstream demand triggers the next step in the production process, starting with customer demand for a finished product, and then we work backwards. So demand pulls an order through the production line rather than MRP, which tends to push an order through the production line. Some of the production goals of JIT is meet the customer demand on a timely basis with high quality products at the lowest possible cost. Some of the features of JIT is that you may find that the manufacturing operation is arranged in cells rather than departments, and a cell is a grouping of all the different types of equipment used to make a given product. It may be laid out in a U fashion so that workers can work within their cell without having to move very much. A U shape of a U format is very common in JIT production environments. And then we cross-train workers so that they can operate on all the machines within that manufacturing cell. So cross-chaining and multi-skilled workers is also a feature you find in JIT production. The goal, we tend to aggressively eliminate defects. If you think about it, it makes sense. If we're only making product when it is needed, we're not storing inventory, so we do not have spare units available in the event of a defect. So what's real key here is that we are minimizing or maybe even eliminating defects. Another feature of JIT production is if we've set everything up right and we've organized it in a JIT pull fashion, we reduce setup time. Suppliers are selected on the basis of their ability to deliver quality materials in a timely manner. Very key in a JIT world. Some other benefits of JIT production is that it may or typically has lower overhead costs, certainly lower inventory levels, and there is a heightened emphasis on quality improvement because it's very much focused on eliminating waste, eliminating rework, and eliminating scrap if possible. Now, there is scrap inherent in many manufacturing processes. Okay? It also typically has shorter manufacturing lead times. That's a significant benefit of JIT. Now, when you think about JIT in combination with application software, enterprise resource planning systems, typically called ERP, which are accounting and other business modules all combined together, JIT's success hinges on the speed of the information flow from the customers to manufacturers to suppliers. So with ERP, there's a system that is feeding a single database, or actually it could involve multiple databases, but from the user's perspective, it operates as a single database that collects data and feeds them into various software applications to support all of the business's critical activities. Not every activity, but ERP typically covers a lot, including costing, general ledger, accounts payable, sales, order entry, and there may be other modules as well. Manufacturing, shop floor control. There may even be distribution requirements planning, and certainly materials requirements planning is a module you'll see in ERP as well. So ERP gives managers, workers, and customers access to the information. It can be expensive, very large and unwieldy, particularly to implement, yet it's very popular. JIT a lot of times can simplify that. However, you still need some information originating in ERP systems if you're using them in your business context and in your various businesses. All right. Performance measures and controls in JIT typically involve looking at the inventory turnover ratio, but there's also non-financial performance measures that are just as critical. And they're measures of time and inventory and quality, such as manufacturing lead time, units produced per hour, days of inventory on hand, and setup time as a percentage of total manufacturing time. Another one is number of defective units as a percentage of total units produced. Now let's talk about backflush costing. Backflush costing says we're going to skip recording some or all of the journal entries relating to measuring how the inventory and how production is changing at every stage of production. And this is all part of the conversion process when we go from direct materials to the sale of the finished goods. Since some stages are omitted, the journal entries for a subsequent stage will use a normal or a standard to work backwards and flush out what the cost would have been for whatever that stage was that we're choosing to use backflush costing rather than actually measuring what was produced. Backflush costing is a huge time-saving technique that I have seen in virtually all of the sophisticated manufacturing environments I've worked in. And what I mean by that is, say we have more than 2 or 3 stages of work going on. Say we have a stamping department, then a painting department, then an assembly department. Sometimes we may choose to use backflush costing and only measure transactions at the end of, say, 2 of the 3 departments, or maybe only at the end of production, and we backflush all the way through the organization. Now, it's different than traditional, normal, and standard costing, where they're monitoring sequential tracking. Recording journal entries at each trigger point in the production process. And you can combine backflush costing with traditional standard costing systems and figure out where your pay points are, or where your backflushing transactions where you will record them and backflush through to the last point. Okay? There's some special considerations to consider. It doesn't necessarily comply with GAAP because it's based on standard costs, and unless standard costs are reasonably close to actual costs, they really are not allowed for GAAP. But if the inventory levels are relatively small, it negates the need for compliance to GAAP. Backflush costing also doesn't leave a good audit trail because we're legitimately skipping points at which we're monitoring how goods moved. We're using standards to say, well, if we had 10 units of finished goods and it took 2 sub-assemblies, we must have used 20 in the process. That would be an example of how backflushing can work. So we lose the ability to pinpoint what resources were used at every